Eddie Ghabour is back with us this Wednesday morning. All right, Eddie, tell me, in your opinion, when do we hit bottom on the stock market?
So we need several things to happen before we hit bottom. We need the rate of change of economic activity to stop getting worse. We need the Fed to stop tightening. We've never bottomed in a bear market during a tightening cycle while they're tightening. And we need the dollar and the bond market volatility to stabilize. And lastly, we need this market to price in a recession because we still think we are heading into a recession. And by June, it will be crystal clear that we're in one. So with that, when you're looking at that, it's 6 to 8 months before we probably bottom, in our opinion. And of course, that's subject to change if we get a black swan event or some type of credit event, because that's something that has me most concerned when I look at the commercial real estate business and I see how fast this Fed's been tightening. And it looks like they're going to have to tighten even more with this inflation data getting hot last week. We could have some issues on the real estate side.
Yeah, let me pick up on that because the news from the real estate market has not been good recently. And we are hearing that commercial office developers and owners, there's some danger of default on their loans because people are not going back to the office and they've got all this space that's not used. Is this developing into the kind of credit crunch that you're talking about?
Absolutely. We've been talking about this for months, and I think the commercial space is going to be extremely challenged because the other thing is with this debt, you know, these commercial loans aren't locked in for 30 years like a residential loan is. They have to refinance this debt. So when you're starting to see rentals going away and you got to refinance that debt at maybe double the rate, you know, it's mathematically challenging to be able to support that. And so you're going to see more and more defaults in that. And then you worry about it spilling into other sectors. So look, staying in cash-like instruments has served us very well. It's been a nice yield. And I think when we get to that point, you're going to have some amazing buying opportunities. But patience continues to be key here. And I know these bear bounces make it tough. But at the end of the day, that's the winning equation for our clients, in our opinion.
Just to be clear, you've got a lot of your clients in cash. And by that, you mean in instruments like Treasury securities, right? Short-term Treasuries. That's what you're talking about.
That is correct. Look, the risk-free rate right now in these areas are between 4 and 5%. It's been since, what, 2007 since we've seen anything like that. And when there's so much happening right now, I would argue that no one alive managing money has ever seen anything like this before. We've never had tightening this fast. We've never seen a bubble as big as the one we had in 2021, and we now have to get through that. And lastly, we've been conditioned to believe that the Fed's going to come in and save the day and rates are going to come down. We have to erase that from our mind. We are now going to be in a new normal of higher rates for the foreseeable future. And that means valuations have to get reset. And unfortunately, there's going to be a recession, companies going out of business, and that's the normal cycle. And then we can restart, recalibrate, and back to business as usual.
Well, that would be nice. Can't wait for that. Eddie Ghabour, thank you as ever for being here. See you soon. Thanks a lot.
Thank you.